to welcome Scott. Scott's a regular at our events, and it's
Mhm.
always really great to have him involved. So I approached him and said it'd be really nice if you wanted to lead on a session. He's built a lot of companies as a CFO. He's also been a VC investor. So he's got a lot of experience of raising finance and funding. So we thought it'd be great for him to sort of share some insight and tips today on the things to think about as a CFO. And then, all the bits that are involved in negotiating equity and all that good stuff. So I know Scott wants it to be an interactive session because it's really great when we can have, the benefit of other people's experiences. So I'm going to stop talking and I'm going to hand over to Scott. And yeah, we'll take it from there. Thanks, Scott.
Hey, Christine, nice to meet y'all. First of all, I wanted to start off and say the presentation I'm going to give is primarily focused on financing of tech companies. A lot of the lessons are transferable, but very simplistically. Like I noticed one of you that signed up was from a media company. And one of the things that a lot of entrepreneurs, especially CFOs and founders, run into is they have a requirement for money. And it's basically like, how do I finance my idea? And what you see from the investor standpoint, and I'm going to try and talk both from the operating CFO side, but also the investor standpoint is a lot of times you'll have people approaching you saying, I need X dollars, and I need 5 million, 10 million, 20 million, whatever the number is. And it becomes apparent pretty much within the first 30 seconds how much they know what they're talking about. And it's not a matter of them being dishonest, but it's literally a matter of how much research have they done on you as an investor. And the reason that's important is, for example, if you're doing a healthcare startup company, let's say you're going to find the literal next cure for cancer or a clinical um, cure for something, you're going to talk to a very different type of investor that's going to have very different characteristics than if you're trying to finance the next competitor to OpenAI, the next enterprise software startup, or whatever else. So first of all, you need to make sure that you're finding the right investors to talk to that are focused on not only your specific vertical, but even beyond your vertical, are they focused on your specific deal range size and then also your specific geography? And the reason I say the last one is I spent 4 years working and living full time in the Middle East, pretty much everywhere that's in the news in a not good way, given what's going on in the Persian Gulf right now, working on behalf of the national oil company of Saudi Arabia called Saudi Aramco, running a venture fund for them. Although I was using oil and gas money to make the investments, it was purely focused on doing early stage tech deals over there. And what ends up happening a lot of times is people will approach somebody and say, okay, you're a healthcare investor. And as a healthcare investor, I'm going to do an enterprise software company. It literally doesn't matter if you factually have the next cure for cancer that's validated by the FDA, CDC, you've got clinical proof, you've got distribution partnerships and all that stuff. It doesn't matter if you approach that investor and say, hey, this is going to be the cure for cancer. And you look at it and go, well, I do tech deals. It's literally a waste of time. The other thing to understand is a lot of founders, especially over the past 20 to 30 years that I've dealt with, will approach investors where they've got what I'd call good lifestyle businesses. So if you look at companies that are, say, 5, 10, $20 million in revenue, profitable with strong cash flows, that they've somehow managed to bootstrap their way to that, they might have a good lifestyle business. So maybe they literally work 9 to 5, maybe they're paying themselves $350,000, $500,000 a year. But they're like, this is kind of boring. I've been doing this for 20 years. I'm not seeing really rapid growth, and I'd really like to cash out. So when you approach investors, you need to understand what are their target returns. So Christine, if we can go to the first slide, I don't know if you
Yeah, let me just bring up, sorry, I'm
see
going
it
to
or
share
not.
my screen. Hang on.
As I was talking about, you've got different ideas in terms of what the investors that you're talking to are looking for. And what you need to understand is when you're approaching them for money, there's obviously two sides of the table. So if you're the founder, CFO approaching them, Corey, your objective is to get money in the door and get it done as quickly as possible. When you're negotiating before that first round investment comes in, your job is, first of all, to be organized, understand how much money you need, how much money you're trying to raise, but also what do you think the returns are? And the returns are really important because for venture capital, although there historically have been the highest returns, the top quartile, which is what every fund tries to be, every fund espouses to be, but factually it's not, is just over 24%. And the reason for that 24% is although you look at 2017 and you look at 2026, and you're like, well, it's 9 years later, that really doesn't make any sense. Venture capital funds have a 10-year life cycle. And that life cycle is important because venture funds go through what's called a J curve. And what that means is the way the venture fund pays their bills, pays their staff, pays their operating expenses, is they typically will have between 2.5% management fee annually. They used to cover that. So what that means is if you're doing an early stage startup company, It's not that you can't make an investment today and literally sell tomorrow, 6 months from now, and make a huge home run. But stereotypically, the expectation with a good venture fund is historically 5 to 7 years. More recently, it's gotten between 7 to 10 years, and that's causing them some issues at the fund level because of the fact they've got a 10-year fund life cycle, and typically most funds will have automatic 2-year extensions done annually. But if they go much past that 2-year extension, so the 12-year extension period, that's when they start running into problems. They have to start doing secondary sales. But when you look at the average returns for venture funds, it's actually about 13.5% versus the 24% for targeted. MSCI is one of the leading financial institutions that tracks this type of information, and they're showing their world returns. And again, seems low compared to what venture funds are, but again, it's across many different verticals of 13.5%. Source for that was Cambridge data for Q4 of 2025 and then Carta. The next stage is growth equity, where typically that's going to be the second highest returning at roughly 20%, but they've actually only slightly beaten a 13.7% over the last 10 years. Again, the source for that is Cambridge for Q4 of 2025. Buyout is when you think about really big, these are the kind of deals that get announced in the Wall Street Journal. So if any of you have seen the old movie Barbarians at the Gate, that was about the KKR buyout of RJR Nabisco, that's a classic case of buyout. But you're even seeing it in the tech sector with firms like Thoma Bravo that's based in Miami. That's one of the most aggressive for paying top dollars. But on top of that, because of their operational post-investment approaches and their M&A approaches and the capital they put to work, even though they're paying at the top of the market, they're stereotypically able to drive much higher returns than a traditional buyout fund, which is, it says, 18-20%. I haven't seen Thoma Bravo's numbers, but I expect they're probably somewhere around the 30 to 40% range. The benchmark for this, as I mentioned, is the MSCI World Benchmark, and the source for that was the Wellington Management Survey. And Wellington Management is one of the top alternative investors with over $1 trillion investments under management. The key thing is, as I was talking about, if you have that lifestyle investment, do your return characteristics even justify raising money? If you've got that good business, it's maybe a $5-10 million a year business where you've got a great lifestyle, it could actually be in your best interest and be a better outcome than if you go out and raise money. Because if you raise money, one of the key things you're going to be giving up is with that lifestyle business, you've got the ability to say, okay, maybe I want to grow 20%, maybe I want to grow 10%, or maybe I'm fine with just flat revenue growth. Whereas once you take that money, you are committing to a growth plan. So that could take a business that's cash flow positive, very profitable, and force you in a situation where you've got to take the money you've raised and specifically have plans on how you're going to invest that and how you're going to drive the growth. We go to the next slide, please, Christine.
Not letting me. Hang on. I don't know what's happened. It won't let me move. I'm really sorry.
No problem. Let me see if I can get it on my computer.
I have no idea what's happened. Okay, got it. I don't know what happened. I'm sorry.
No problem. So as we talked about, there's a couple things to look at. First of all, the key question is what stage is your company, what stage is your idea, and how much do you need? How much you need is a critical determining factor, because if you understand the fund dynamics characteristics of it, the typical fund will stereotypically have a maximum of 10% of their total fund for that discrete investment pool of committed capital to one individual company. So if you think about simple numbers of a $100 million fund, that means their maximum total investment per company for the lifetime of the entire company is 10 million. So what that means is if they've got a 10 million, they're most likely going to be looking at $2.5 to $5 million investment per investment round, depending on the stage. Again, if you're much later stage, it could be a one and done. So in that case, they could potentially put in the whole $10 million, but stereotypically, that's going to be much different dynamics with the early stage technology companies. The other thing to look at is obviously when you need it. Obviously, everybody wants to do a meeting today, have lunch, and then have the money in the bank tomorrow. Realistically, that's not going to happen. It can happen, but the kind of companies that happens with is where you've got founders that have built companies, had really big exits, think 50, 100, 200, $500 million or more. And then from there, there's a lot of intense competition to get in the deal. So because people have met with them, dealt with them in the past, done their due diligence on them, and they can see there's a verifiable substantial exit. Again, it's not going to happen in 24 hours. You typically be looking at 30, 60 days at the fastest, but I have seen them close as fast as 2 weeks. The other thing to look at is how you synchronize that to the best time to approach. And from there, Part of it is obviously getting your story organized before you go to the investors. But then on top of that, even looking at your calendar schedules. So we all know that we're obviously in the middle of summer vacation right now. As much as people like to think the investors spend all their time working 24/7, all of them have got families too. So it's not impossible, but the likelihood of closing a round of financing, unless it's a follow-on round of financing in the middle of summer right now, is pretty much slim to nil. Your best time to try and do it is following Labor Day before Thanksgiving. So what you want to do is spend the time over the summer getting your ducks in a row to make sure you've got everything ready to go. From there, you also want to look at the fund cycles as well. And the fund cycles are important. As I mentioned, you've got the 10-year life cycle for the funds, but you also want to look. So let's say it's a 7-year into their most recent fund that they're looking at. How is their fund doing? And the reason that how is that fund doing will help you justify how much risk they're willing to take on. So for example, if they've had a multi-billion dollar exit and it's a $100, $200 million fund, they've already repaid back their fund. They've already provided returns to their investors. In that case, they're never going to intentionally waste money, but their ability to take bigger swings for higher risk deals they think will provide much higher returns is much more aligned with an earlier stage company than if you can see they've had 4 or 5 of their investments shut down. In that case, even though they might focus on earlier stage deals, they're probably going to be a little bit more reticent to take the high risk types of opportunities to look at. As we talked about, you get different funds that focus on different rounds of financing. But when you look at how to target them, understand you typically want to have a tiered approach. So if you think back, let's assume go back to high school, we all have when we were single, you go back to dating and say, okay, well, in the perfect world, I want to date the homecoming queen or the homecoming king. But obviously not everybody can do that. Think about how you rank the investors. So create a list of investors you think are the right investors, but then rank them in terms of the perfect investor would be these 3 or 4 funds. Approach them all one at a time with the right introductions to get to them. But then on top of that, as you start getting feedback from those investors, no matter how careful and how thorough you are, investors will always throw a curveball at you might not be able to see. So if you get feedback, if you get it from one, probably not the end of the world. If you target 5 at a time, let's say, you can even use the same email, but don't send the same email to all 5 of them the same message. You can actually take that feedback. So let's say you burn the first 5 bridges because you weren't ready or something wasn't aligned the way you thought it should have been. From there, take that feedback, fix it, and then go to your next 5 and then work your way down. The other thing to look at is their fund size. As we talked about, that's going to dictate how much money they've invested. But there's not only the fund size and what they say, but look at what they've actually done. The key thing here is a lot of investors will say, I do early seed stage deals. But when you look at doing early seed stage deals and then you see them writing 5, 10, $20 million checks, that's not an early seed stage deal. That's much more traditional A, B round types of investments for what's going on. And then the last thing is, are they still investing? That's what we're talking about. Nobody's going to ever say we've shut our doors, but when a venture fund shuts down, it's not the same as if a company shuts down. If you see companies like WeWork would be a good example, where they went into bankruptcy, that was obviously front page news. You're not going to ever see it's not that you'll never see news of a venture fund shutting down, but when a venture fund shuts down, they just kind of take down their website. And frequently, even if they've shut down the fund, they'll still keep their website up and running for a long period of time because even though they might not be in the market making new investments, they've still got existing portfolio companies out there and they want to be able to keep the facade going that they're still investing. From there, you got the fund dynamics. So you not only want to understand, is it the right fund? Are they targeting your sector? Are they able to commit new capital? Do they still have funds left in the current fund they're managing? But are they ethical? That's both from a fund perspective and also from the general partner perspective or managing director level that you're dealing with. That doesn't mean that they're going to give away the farm when they negotiate with you. It's their job prior to the investment to make sure that they're negotiating the maximum amount of equity possible for the least amount of capital while still providing the resources that you need to execute on your plan. From the money, we've talked about, do they have the capital under management they actually want to be able to do? You also want to look at firms that they've succeeded with in the past in terms of co-investors. And the reason that's important is if you go to them and say, look, I know you've worked with these 3 funds over here and you've done 20 deals, it shows you've done your diligence on it, but ideally you've done your diligence. And the reason that you're looking at working with them, and ideally they're 2 or 3 syndicate funds, is specifically because of the fact that they've had success in the same space. And obviously if they've had success in the same space, they're going to be predisposed to trying to make another investment because they've been money in that sector before. Whereas if they've lost money, obviously it's not that it's impossible, but that's a much harder road to go up if they've lost money in your sector before to get them to do it again. The other thing to understand is, as we talked about earlier, you've got sacrifices that you're making. So again, if you have that profitable, strong cash flow business, you are going to have to sacrifice things like equity, board seats, control. But then on top of that, what are the investors specifically going to require? So even though they might not have over 50%, so theoretically you could have 60%, from an equity perspective, you're going to control the company. Realistically, though, if you're in a situation of relying on the capital that those investors are providing, even if they've only got 40%, understand they really have control of the company, whether you want them to or not. The other thing that a lot of founders don't like is if they've already built a company, in certain situations, you might not have to reset your stock to vest. But if I'm an investor putting new money in and you build a company over a 5, 10 year period, maybe I'll let you take a portion of the money off the table, call it $1 million, some round number, assuming it's a $10 million investment. But stereotypically, they're going to want you to take the equity that you own in the company and restart the vesting clock. The reason for that is not that they're trying to steal anything from you, but they want to make sure they're putting their capital on the line. They're counting on you as the management team to build and grow their capital 5, 10, 20 times before that. The other thing you want to look at is, are there any team members that you're potentially thinking about replacing? That could be maybe you've got a CFO that's a CPA that's maybe more of a bookkeeper level. So it's not a matter of firing that person. And obviously on this call, I'm assuming most of us are CFOs, but you want to look at it and say, are there any particular people or holes in the management team that I think that the investor would want to work with me on? A CFO is very stereotypically one of the ones that they'll want to work with them on. It's not that they want to invest in a company that's already got a CFO. That's not it at all. But given the proximity to the money that they're investing, a CFO is typically one of their strategic hires that they'll want to be intimately involved with. So it's not the end of the world if you don't have a CFO when you approach them. Just to understand that with mom and pop or friends and family, or what they call the friends, family, and fools, the 3 Fs, you can have a lot more leeway about bringing on a CFO versus if you raise 10, 20, $30 million in equity, it's not going to be required to have that person day one, but you better have a search out with somebody like Chris within the first 30 days to get that online. Chris is smiling because obviously she wants the searches out of this. The other thing you look at this with is, as I mentioned, you want to look at the syndicate partners. If you look at firms that have had a lot of success, investing is very much a team sport. So when they look at investing, there are typically funds that they've had success with over and over again. And as a result, they'll have very close syndicate partners there. And that's also really important for you as the entrepreneur and the founders and the CFOs, because when you look at this, you should look at it as a marriage, but a marriage that you can't get out of. I mean, you can't get out of it, but the only way you get out of it is literally by leaving the company. And that's a very painful financial process to go through. So you definitely need to make sure that you're working with people you trust, get along with, and are very straightforward and honest. The last thing a lot of people don't think about is, what do you not want to give up? And this is really important because, as we talked about, your job as an entrepreneur is to bring the money in. My job as the investor is to invest the least amount of money possible, but buy as much equity as possible. So I'm not doing a bad job negotiating with you. I'm not being dishonest. I'm taking care of my investors' fiduciary responsibility they've entrusted me with capital for. The other thing to look at is, if you're somebody who's been working with the company for 10, 15 years, it's okay to say, I'm 60 years old, I'm planning on retiring the next 5 years. Day one, that's not an issue. On the other hand, if you're, say, 64 and you're like, I've made my $10 million, so I'm living in Florida on the beach, so you're going to invest today and I'm going to be hitting the beach tomorrow. You want to be straightforward if that's your plan. But again, that's the kind of thing that they need to know up front, but also understand what kind of time commitment they're looking at. And that's where that vesting comes back in place. Last but not least, you also want to understand your valuation. So the investors are always going to do the best that they can in terms of negotiating the lowest valuation they can. Where a lot of entrepreneurs get tripped up is they say, well, I think this investor's paying me too low a valuation. But realistically, what's happening is, it doesn't matter what the investor says for valuation. If you think your company's worth 20 million, 50 million, and the investor says, based on the financials and comparables for other companies that have been financed in the same space, this is only a $5, $10 million deal. So what you need to understand is, do you want to own 100% of a $5 million company, or would you rather own, say, 10, 20% of a $100 million company? And again, that's just a different thing to understand. The other thing that a lot of entrepreneurs don't think about as they're negotiating for things like this is, you also want to have what you consider your walkaway number. So that's not a number you disclose to your investors, but if you think, and everybody's got different numbers in mind, but if you think $10 million of your sale price in terms of your own personal takeaway money once that transaction's closed is the right number, make sure that your number for what you personally think is the right number for you to take and walk away from is going to align with what the investor's expectations are for the company. If those numbers aren't aligning, that's obviously something you want to try and negotiate before you close the deal. The time to have these negotiations is once they show interest in investing, but also once they've already started down the process. You want to be clear and upfront about what's happening before, but at the same time, if you're ready to sign a term sheet going into closing a deal on Friday this week, you don't want to come in and say, we're talking about a $100 million valuation before a $10 million investment for the last 3 months. I'm thinking the right number is $200 million. In that situation, the investor's not going to walk away, not going to follow through. They're just going to say, you're really off your rocker. We've talked about $100 million. So maybe we ended up at 90, 110 million, roughly the same number. That's a very different conversation where you've had that $100 million conversation. And then you're telling them 2 days before you're about to sign a term sheet and close, you're thinking that number's 2x. At that point in time, you've lost a lot of credibility with them. And then more importantly, trust. And that trust is critical for what's going on. The other thing that sounds really crazy with this is if you think about it, again, putting back to the high school scenario, sorry, I've got 3 kids. So I keep thinking about in terms of what they're going through in high school and college. If you think about it, you want to be able to get to a position of closing as quickly as you can. The reason for that is while your company is your blood, sweat, and tears you spent months, years of your life working on, to an investor, your company is purely a deal. Don't take that as a negative. It's just the volume of opportunities they see. They will stereotypically look at roughly 1,000 opportunities before saying yes to one opportunity that they actually make the investment in. That's not to say they close each of those 1 in 1,000 opportunities, but stereotypically, those are the numbers you're looking at. So the other thing a lot of entrepreneurs get down about is investors can sometimes be negative, and it stereotypically happens with people that are been doing this for 10, 20, 30 years. The reason for that is not that they're jerks, but they literally, if you think about, again, if with my kids, I know that we used to tell them no 1,000 times for every time and say, yes, you can do this. So as a result, if you go to work and it's bad enough doing that at home, you've got to do that with your kids. You can't get out of that. At work, you can easily get in a situation where you said no 10,000 times and you said yes 10 times. Think about how you'd be on the other end of giving that no answer that 10,000 times. Go to the next slide, please, Christian.
Yeah, I don't know why I'm having so many issues. There we go.
Scott, can I ask a quick question?
Sure.
If you go back to the investor targeting detail or background that you gave us, can you explain why you would go to one investor at a time as opposed to like a blanket approach saying, hey, you've identified the 5 top
Sure.
investor targets, just to give us some background on why that's important or what's happening. Maybe they're talking amongst investors and you don't realize it, but I think that would be helpful.
Sure. So I would tell you a couple things, Christine. First of all, you want to have a rank priority based on, as we talked about, that very first slide, I showed you the difference between the median return. And again, that's across all sectors. So very simply, historically, healthcare has been a good area to invest in. National defense has been a good area to invest in. But the return characteristics for those types of industry verticals are very different than, say, AI. If you look at, you don't have to be a rocket scientist to see most of the private equity and venture capital investing in the current market, I would say over the last 3 to 5 years, has primarily gone to anything with AI invested in it. In my opinion, it's overinvested in. I think a lot of those investors are going to lose their shirts when the chickens come home to roost. But the other thing you want to do is you want to have a focused approach. So in my case, I've dealt with literally thousands of investors over my career. I don't need to do research to say, I'm not picking anybody. Let's say Robert, Troy, and Adam that are on this call. If I've done deals with them for the past 20 years, sorry, just pick you guys because you were the 3 people around Christine. But if I've done deals with them, I know them personally. I know what kinds of things they'll be invested in. I know how they're going to add value post-investment other than the money. But last but not least, you also want to have, ideally, you want to deal with investors that are closer to you with earlier stage companies. It's not that investors from funds, say in California, I know I'm in DC. I founded the first fund I did on September 10th, 2001 in DC with 3 of the premier funds from San Antonio Road in California. Obviously, we had no idea what was going to happen the next day. The reason that they invested in our fund to create the local presence was investing is very stereotypically, even in the tech sector, something you do face to face. Zoom and things, again, this was 2000, sorry, not 1991, 2001. In 2001, there were early video calls, but it was when you still had those Tandberg video terminals that most startup companies couldn't afford. So the other thing you want to do is, like you were mentioning, Christine, there is a lot of talk among investors. So It's not specifically they're going to talk about your company or your deal, but stereotypically what will happen is you might go to an investor conference over, say, a once a quarter period. You might go to listen to investor pitches. Stereotypically, the companies that are pitching, if they're pitching, they've probably already got commitments for the round they're out closing right now. It's more to seed the market for the next time, say 12, 18 months from now. But where the real deals happen is when you go to those conferences, you talk to 20, 50 people you know, and you just ask them very straightforward, what have you seen that's interesting? And then from there, you just listen. And it's that kind of area that it gets important. And by targeting it, as I mentioned, if you're not intentionally going to approach them and make a mistake in your presentation or assumptions or financials, but let's say you've got a targeted list of 100 investors you want to go after. It's impossible to do research on all 100 investors before actually talking to them. And if you screw things up, it's better to screw things up with the first 5, so you've still got 95 to go after. And you want to give them a cadence. So the approach that I took, and this is when I worked at Ernst & Young, I founded and ran a practice called the Venture Capital Advisory Group. And we were competing against PricewaterhouseCoopers. I was competing against a team of 5 people that had an 18-month head start on me. And I was in the number 3 market for venture dollars invested. When I went out to talk to the investors that I was working with before I was on the investor side, the first thing they said was, we're seeing plenty of deal flow from PwC. So I couldn't badmouth PwC in those meetings, but I turned around and I said, that's great. I said, you've been seeing opportunities for them for the past 18 months. How many of those have you invested in? Because investors, like anybody else, it's all about the amount of time that they've got. Well, we've all got 24 hours a day, 7 days a week. So they hadn't actually thought, and again, from a timing perspective, this was 99, 2001. They looked at it and said, it's actually an interesting question. I said, come to think of it, we haven't invested anything. And I said, so if you give me an idea of who your investors are in your funds, and I would know the people I was meeting with for lunch or breakfast or coffee, so I'd have the information beforehand, I would typically go into it and have very specific questions like, oh, I see you worked with this. This was before LinkedIn was around. I see you were invested in this deal. I see you went, one of the guys I worked with was an attorney at Cooley, and he was a great law firm partner, but he actually happened to have been a Lockheed Martin rocket scientist when he first graduated from UVA. So when he left the law firm of Cooley, where he co-founded the East Coast office, he now runs a firm called Razorsight Ventures, and he's actually one of the top rocket investors in the country. I mean, it's not a career path that anybody would have seen, but again, if you knew he'd been an attorney for 20 years, you'd say, well, I understand he's a great attorney. What does he know about rockets? But if you knew what he did before he was an attorney to pay for law school, that would make a lot of sense. Did I answer your question, Christine? The other thing too is you don't want to get in a situation where you get to be what's called a shopped deal. So you really want to set yourself up as, call it the belle of the ball, whether you're the man or the woman in the analogy. So you want to be the perfect opportunity that's got the highest return expectations with all the competition. You don't have to lie about what's going on, but one of the questions people will ask you if you get to an investor meeting is they'll say, who else are you talking to? You might have the list of 5 investors you're talking to. I would never advise you to specifically list those 5 funds, because if the investor is actually interested in doing it, I probably know those 5 other funds personally. If they're in the same space, I probably come across them or dealt with them on past deals. So I can call them up and say, hey, I see you're looking at Christine's deal. We're looking at investing too. Let's syndicate on this. And instead of me competing against their term sheet, I'll literally synchronize and say, okay, well, I think I'm going to offer a $10 million pre-money valuation for a $5 million investment. So that would be the key reason you don't want to do that.
Thank you.
Well, as part of this, one of the key things you want to do, and the best way to do this if you haven't done it before, is being confident but not arrogant, is to be prepared. You want to know who the fund's investors are as much as you can, what the specific investor you're talking to is, understand how their funds work. And a good example of that is NEA is one of the biggest early stage investors in the country. They manage, I think it's about $3.5 billion through 3 offices in Maryland, New York, and California right now. They've even got a couple of people operating out of Texas. While they're very big, and I don't know what their exact number of partners is, I believe it's about 20 right now. If one of their partners says no, even if it's not one of their deals, you could have 19 out of 20 that say this is the best thing, the best opportunity since sliced bread. But if I'm the 20th partner and I say, again, no offense, Christine, but I say Christine's opportunity is not right, we should do this, that could be enough to kill it. Whereas other firms like Benchmark is a much smaller partnership, but has had much higher returns. They literally take or Bessemer is another good example. those specific firms will hold the partners accountable. So the partner will have the authority to invest if they say, I think this is going to be the best thing. At the same time, if it blows up in their face, they're they don't have to repay the money, but clearly they need to have more money making deals than money losing deals. And very simply, if they're not able to produce that, the investors are shown the door over a long period of time. The other thing to look at is how you get introduced to them. And the introductions are really critical. In today's day and time frame, you'll hear a lot of investors say, it's okay to reach out to me on LinkedIn. It's okay to send me a cold email. It's not that those will not work, but if you think about it in terms of, and again, I'm sure Chris could talk about this for the number of applications she sees for CFO searches she does. If she's got 200 applications for CFOs, you could be the perfect candidate out of those 200. But if she doesn't know you and she knows she's dealt with Troy and she's placed him 3 times, she's like, he's done a great job. He sold 3 companies. She's naturally going to be predisposed to respond to Troy's email coming in saying, hey, I just sold my last company last week, Christine. I'd love to talk to you about what's next, to do that. So when you find introductions to the funds, you want to look at the ideal situation is entrepreneurs that those funds or ideally that specific partner have invested in and made money with in the past. Next great introduction would be if you can figure out who their limited partners or who the fund's investors are. That's also a good way, but it's good in the sense you get a response. But what I've seen is limited partners can sometimes hurt you. The limited partners are the source of capital, so the investors will absolutely respond to them. What I can tell you is I've had limited partners introduce deals to me, and while they've been a great source of capital to invest, they candidly don't understand what they're doing. So just because somebody provides an introduction doesn't mean you're going to get an investment. You might get on a phone call with them. The other ways that I found that are really good is the right transaction law firms. So Cooley is among the top there. DLA Piper Rudnick is also really good, but you want to have the right partners from the right firms. So Cooley could be the best, biggest law firm for transaction work. At the same time, if you've got like one guy I know who left Cooley was a real estate partner there, one of the top guys in the DC area. While he's extremely good at real estate deals, he's not the right person to provide an introduction to a venture fund, because as good as he is at doing real estate development deals, he just doesn't have the right background to be able to do it for the venture deals that's going on there. The other ones that are really good is, and this is the role that I had with Ernst & Young starting the Venture Capital Advisory Group, the big 4 firms have institutionalized this stuff over the last 30 years because private equity and venture has become such a growth market for them. So if you can find the right people within those big 4 firms to provide the introductions, the ideal people would be Ernst & Young's got an incredible entrepreneurial services practice, and they have what's called private, which is the larger growth stage investments that are going on. Those firms have typically got really good relationships there. And from there, you'll typically have partners that have done a lot of work with the venture funds or the private equity funds that have done it. If you can find an introduction from somebody like that, they can tell you, look, I've dealt with 50 clients that have worked there. Not all of them have been successful, but here's the 30 I've seen that have been successful. And I know these particular firms and I've had a really great relationship. The other thing you want to use those introductions for is you can find information out online, but you also, before you go into talking to funds, you want to make sure that the funds you're dealing with, as we talked about earlier, they've got to be honest. It's not rocket science to say not everybody's honest out there. You're never going to be able to get any venture fund to sign a non-disclosure agreement. And very simply, the reason for that is they see hundreds of thousands of opportunities a week. So if they had to keep track of every non-disclosure agreement they signed, they'd spend more time reviewing non-disclosure agreements versus actually getting deals done. At the same time, the best investors will be able to see 20 or 30 opportunities in the same space. And even though you're not trying to do it, stereotypical what will happen is there'll be some kind of a Wall Street Journal or some kind of business article that comes out and says, this is the next hottest area. So then 20 entrepreneurs will write the same business plan, and then not knowing it, those same 20 entrepreneurs will send the same their idea, their take on how to do that to the same group of investors. So they might look at it and say, okay, I've seen all 20 of these deals. It's not that if they invest in company number 20, they're not going to share what they saw from 1 to 19. But what will happen is, as a result of reading 20 approaches to the same problem, the investor will get smarter about what they think will work, what won't work. So that's legitimate. They're not sharing your specific idea. But if they say, I'm looking at 20 different ways that I could do this, okay, opportunity number 1 is Christine's over here. Opportunity number 2 is Adam's. Opportunity number 3 is David's. These are the things that I don't think will work, or I thought these 3 things would work, but I can see from the very articulate responses that I've gotten or submissions that I've got from these business plans that this won't work. The other thing to look at it, and this gets to your other question, Christine, about why not approach all 20 or all 100 of them at once, is as you go in and talk to them, you need to be able to listen to their signals. So are they playing around on their phones, their iPads, or are they actually focused on what you're doing? Have they read the information you've sent them ahead of time? Have they prepared questions? And even if they haven't, you should think before you go into those presentations, what are the holes that somebody could try and poke in my approach? If I'm trying to raise $100 million and I actually only need $5 million, it would be great to have the press release that says I raised $100 million. Realistically, if I'm only raised $5 million, even if they're willing to invest $100 million, you're selling a lot more equity, leaving a lot of money on the table versus raising the right amount of money for that, for what's going on. And if you do it in tiers, I've typically seen 5 being the right number. That's just me. Somebody that sends it out to you and follows up for you, it's not that you're being lazy, but me sending out a deal to somebody I've worked with, I'll typically send it out on a Monday morning. I'll give them a week to look at it. And then from there, follow up with them via phone call to schedule a call for it. In that situation, that's a really good introduction because it shows whoever sent you the introduction for your opportunity is involved with it. It's not just, hey, Christine sent me an email and this looks compelling. I'm going to send it to this investor over here and I'm not going to follow up. That's useless. What I would say is if somebody offers to provide an introduction, understand and ask them. Say, first of all, thanks very much. Appreciate your introduction. That's a big help for you. That's going to elevate you above that 1,000 opportunities that have come in and hit that investor's inbox at the same time. Understand what their motivation is for the introduction. So it doesn't necessarily mean that they need a placement fee. Sometimes it could be, I've had a really good relationship with this investor. They were my investor and I want to kind of pay it forward that way. And obviously I like you. I think you're credible. Obviously, if I don't think you're credible, I'm going to find a polite way of saying, I don't think this is the right opportunity to introduce to them. But you also want to specifically know, don't go to them and say, do you know any investors you can introduce me to? Go to them with a specific ask. I'm interested in talking to this person at this fund. Here's why. And do it that way, because if it's a specific ask, it might be somebody I've connected with on LinkedIn and I've had 1 or 2 conversations with. So I can tell you, Christine, I think this is a great opportunity, but I don't know that person very well. It's a straightforward opportunity. Not the answer you want to know, but that's good information because then you haven't used an introduction you were thinking was going to help you that didn't actually do anything for you. But if you get feedback from the investors that you've talked to as part of those early presentations that are no, take that feedback. If it's only one time, listen really carefully for the 2nd through 5th presentation you're making and see if you get similar feedback. If you do, maybe you want to look at, maybe you are doing something wrong. Last but not least, you also want to have your document set up in a secure data room. It doesn't have to be anything complex. It could be something like a OneDrive file that you've set up as part of your Office 365. Obviously, just don't publish that information. And when you share it, just enable people to either look at it, download it, forward it, or modify it. And I would suggest having a separate file for that on something like OneDrive or Dropbox, or even secure data platforms to be able to manage what's going on there. Can you go to the next slide, please, Christine? As we talked about earlier, obviously we're in the middle of summer vacation right now, so timing for when you approach them is critical. And the reason that's important is, as we talked about, I mean, people have got vacations that are going on. The ideal time is very stereotypically right after the first of the year or right after Labor Day going into Thanksgiving. Realistically, it's not that you can't close financing between, say, Thanksgiving and Christmas, but you're not going to go from a first meeting, say, December 1st to closing by December 24th and have a Merry Christmas and Happy New Year. The things that are closing between Thanksgiving and Christmas are things that have started in that September to November timeframe period. And maybe for whatever reason, they were planning on closing before Thanksgiving, but say those 2 or 3 things got held up in due diligence or legal documentations or agreements or things like that that needed to happen. Or potentially the other thing that could happen is the funds themselves have commitments that have taken place on a calendar basis. So if I go out and raise a new fund every 3 years, my limited partners have got a certain allocation for early stage investment, venture, buyout, growth, mezzanine. So they need to understand what the deployment schedule is, because even though they've got the commitments, maybe an investor says, look, I can commit to this fund, but I'm not going to be able to release funds to you. If I commit to it in 2026, maybe I'm telling you I'm going to commit to it in 2026, but I'm not going to be able to finance any commitments for this in 2027. That's the kind of thing that's not going to be publicly known. But if you're talking to investors saying, hey, I'm talking to you on July 15th and I really need to close by August 15th, I can tell you, look, there was a press release that went out for $500 million. That's a true statement. What was not publicly released is the fact that our investors have told us that because we raised our fund 2 years ago, they were willing to commit to this to get us on the calendar for 2027, but they told us they can't release funds until January of 2027. That's obviously not going to meet your timeline for what's going on. The other thing that can help push your deal forwards is think about positive momentum that you can demonstrate to them. So as you look at it, it's not only just the calendar timeframe in terms of holidays, things like that. In the ideal situation, you want to look at it and think about things like 6, 12, 18 months before you need to raise money. Reach out to them ahead of time and just try and schedule an introductory call and say, we're working on this new opportunity. We just closed our first round of financing 2 months ago. Although we're not in the market raising money now, what we'd like to do is start talking to high quality investors like yourself to prepare you. And as part of that, you'll have the same presentation, but instead of doing the same presentation you did to close your first round, say 2 months ago, you look at it and say, this is our business plan. This is what we're forecasting for growth, number of customer wins, key product development milestones, and things like that are taking place. And from there, even though you're not trying to close money, if I can see that I've been talking to you on maybe I tell you, really interested in what you guys are doing. I'd love to have a quarterly update with you guys. You don't need to share the most proprietary information you've got, but you can share very high level positive outlooks. And then from there, if you can talk about it and say, we told our investors for the first round, we're going to close 10 customers. I can tell you right now, we've already got 8 of them closed and we're only 2 months in. That's the kind of thing that's going to push me to say, even though your company's not trying to raise money for the next 12 to 18 months, if you've already closed 8 customers and you're only 2 months in, that shows there's really positive sales momentum there. Help me understand why that is. What is it that's driving that? The other thing that can help drive it forward is I've seen companies recruit executives, typically CEOs, CFOs, VP of sales from the right sectors that join. So even though that person might not be announced, maybe I've recruited somebody out of Salesforce, I'm doing a competitive CRM sector. If I can share that person's name, again, share it confidentially, don't put it in writing, but make sure that if you share somebody's name, that they're on board, they've gotten it off, and maybe they're waiting to collect their year-end bonus or something like that. You can share it with the investor and say, look, we've got the VP of sales from Salesforce that drove $500 million in sales in 2025. They're planning on joining January 1st of 2027. So not only have we had 10 customer wins, we've also got the top performing VP of sales from Salesforce that's right in the sweet spot for what we're targeting. And last but not least, you also want to look at business development partnerships. So as you look at sales, there's obviously multiple channels you can sell through. You can do direct sales where you've got your own sales force that's out there, but you've also got channel partnerships. So if you have any kind of major deals or announcements that are coming there, talk to them and say, okay, we're working on these 3 to 5 partnerships. Maybe it's IBM, maybe it's Cisco, maybe it's Salesforce, Oracle, whoever it is, or Amazon Web Services. Talk to them about how those are being structured, how they're being set up, and then talk them through the logic between why is going through a partner sales channel better than direct sales. And then obviously have financial metrics to talk about what's going on there. Next slide, please, Christine. This last one's kind of a joke, but it's actually something that's happened a lot more in social media. In the early days of venture investing, it went from a very boutique industry. So you were probably one phone call away from any investor you needed to get to. Nowadays, there are literally thousands of them out there. So the ones that are making the most amount of noise on social media, stereotypically, like Fred Wilson from, drawing a blank, which firm is Fred Wilson's one of the top investors out of New York. I'm drawing a blank as to which his firm is with now, but he used to be part of Flatiron Partners and started out at Chase Capital Partners. He's very prolific online, does a lot of writing. So he's an exception to the rule where he makes a lot of noise, but he talks about the logic between his approach to investing. And stereotypically, nowadays, the way most funds are structured, the way that partners can help generate deal flow to get to the unseen opportunities is they'll do a lot of blog posting. So if you look at their blogs, could be just on LinkedIn as they're announcing deals that are going forward, that they're already invested in, positive developments. Those kinds of things are great to see. But if you see people that are posting 24 hours a day, 7 days a week, I would look a little bit further. So yes, they might have a lot of name recognition, but if you look a step further and say, well, okay, if this person's the top 10 VC posters out there in terms of social media frequency, that's great. Look at how their investments are actually performing. The best investors are the ones that are focused on bringing in the best deals, making the best returns for their investors, and making sure that when they make a financial commitment and a personal commitment that they're going to be there for the entrepreneurs, that they follow through on doing that. As I mentioned, the best introductions to get to those investors and get their reputations before we talk to them is things like the deal attorneys, big 4 accounting firms, portfolio executives successfully built companies, limited partners, and obviously their prior co-investors. Although it seems like it's much easier and faster to do the direct outreach, it can work, but statistically, you're looking at more of a 1 in a million as opposed to the 1 in 1,000 opportunities you're looking at there. Next slide, please, Christine. This last one's another kind of joke, but I mean, we talked about signaling that matters. you can go into investors and you see them playing with their phones, paying attention to everything that's going on outside of what you're there to present them on. So I would look at it, and again, I told my kids, you've got two eyes, two ears, and one mouth. Make sure you're using it proportionally. It seems really basic and stupid, but if you see the investors paying attention to everything that's going on that you're doing, make sure if you've got people that are paying attention to you, maybe it's a team of 5 partners that are in a meeting. If there's one that's actually paying attention, seems to engage with you, focus in on that. Focus on being really responsive to their questions. And by driving the engagement with that one individual partner, maybe you don't get the attention of the partnership for all 5 of them that were there in that first or second meeting. But that one partner, even if you guys leave, you go back and say, you missed it. This was the right pitch. You guys just weren't paying attention. And from there, that can do a lot more to drive what's going on for what's happening for follow-up calls. The other thing to do is whenever you're in meetings with them, try and schedule your follow-up calls when you're in the meeting, as opposed to having them say, we'll get back to you, or we're interested if you find a lead investor. That's something they're politely saying, but that's more directly them saying no without saying no. The reason most investors will not ever come out and actually say no is not that they're being dishonest. They're people too, and there's always the fear that if they say no directly, they could have missed something. So with them actually coming out and directly saying no, you as the entrepreneur, the CFO would say, well, Scott told me no. This is clearly no. I'm done talking to him. I'm going to go talk to the next person. Whereas if they give you, say, 3 to 5 examples and they say, I'm really impressed with what you're doing. You guys are making really great progress here. Maybe if you go in and you say, we've got 5 customers, maybe if they tell you, we've got 5 customers, but they're only kind of $10,000, $15,000 a month customers in the software space. If you can get to 20, 25 customers that say a $50,000, $100,000 touch point, please come back and that'll change our evaluation on you. That's a way of politely declining what's going on, but still staying involved. And then from there, if they are actually interested in moving forward, try and confirm that next meeting with them why you're actually there. It's a lot easier to do that when you're sitting in front of them as opposed to trying to get them confirmed once you're out of the meeting. And last but not least, as we talked about, the biggest thing that investors are afraid of is fear of missing out. So if you got those other 5 funds that are competing for your deal, don't lie to them and say, I've got 5 funds competing for the deal. Understand that if you say I've got 5 funds, you could be in a situation of them saying, well, if you let me talk to 3 out of those 5 funds, we'll be interested in moving forward. You've got to be able to back up what you're committing to from what's going on in there. Next slide, please, Christine. Now you've actually gotten through the deal process. You've gotten commitments for the funds. You've negotiated financing. It's actually going to work for both sides. Now that the money's arrived, the hard work actually begins. You think that the fundraising process is the hard work. That's actually the easiest part of this process. The hard part is making the 10, 20, 30, 50 times return on the money. So from there, as part of your negotiation, as part of this investment process, understand what you're committing to. You're not only committing to certain growth characteristics, or goals, objectives, but you also have to be committing to things like board meetings. Some funds want it for earlier stage deals. You're typically going to be doing those once a month, sometimes in person, sometimes in today's environment, you can do it via Zoom, or they're going to do quarterly or annually. Expect with earlier stage deals, much higher risk, the hands-on investors, the ones you want to work with that can actually add value, are going to want to do monthly meetings. From there, outside of those board meetings once a month, you want to share news with them as a commitment. That doesn't mean that if one customer says no, you tell them, hey, we talked to 10 customers said no. But understand that if you've got good news to share, if you told them we're expecting to get 10 customers this month and we've talked to 30 customers, we've already confirmed 15 of them, that's the kind of proactive update you want to share ahead of time so they get excited about what's going on. And from there, they've always got a challenge of time. So they need to deal with the fund dynamics in terms of like managing their investor relationships. They've got to deal with their other portfolio companies. They've got to deal with issues that are going on there. Some of them will be going really well. So that in those cases where it's going really well, they've got to help them raise financing to help scale the company faster than they were anticipating. Others are having more problems. Those are typically the ones that are going to take the most amount of time, the least amount of fun, but the difference between getting something for a 30 or 50% write-off versus a complete loss is the difference between the funds that produce the 25, 30, or 40% returns. As part of that, you also want to set up the expectation when you're setting up the board meetings. You don't want to play favorites among your investors. So if you have ideally a syndicate of 2 to 3 funds that you're working with, set up an expectation. Say, look, we're going to obviously provide updates, talk to you guys probably once a week, maybe even every 2 weeks. We want to make sure that we're being clear and transparent with you. Is there anybody that would prefer to be the lead investor, lead board member that we would communicate with? As part of that, you'll typically have a designated general partner, managing director from each fund that's sitting on your board. By default, that's going to be your representative for your particular company. So that's the one you want to talk to. At the same time, you don't want to blindside them. So what could happen is as part of the reporting requirements, maybe have unaudited balance sheet, income statement, and cash flow forecasts for actuals that are going forward. If I'm a general partner at the fund, I would probably want to see those. But if it's a big enough fund, like an NEA where they've got a fund administration group, I could tell you, look, we're interested in seeing this. Send any financial information as far as your monthly reporting requirements to our finance team. They're going to look at it, see if they have any questions. If you've got any market development issues, recruiting issues, financing issues, call me. I'm definitely going to help you with that. Or if you just have some specific questions you think you need to bounce off somebody, definitely call me about that. Just understand what's going on, because what you don't want to do is, in a situation where it's a smaller fund and I'm expecting to see all the information, finance, marketing, strategy, sales, all that stuff, you don't want to be sending it to my partner so that he or she has an idea of what's going on more in my own company than what's happening than I should have. Last but not least, when you're taking the investment, you've also got to think about preparing for an exit. Most investors are not going to invest today with the expectation to sell for 20 or 30 times their money tomorrow. That being said, I have seen a couple situations where somebody invests and literally 2-3 months later, they get an offer that's too good to be true. And they literally have sold for 20, 30 times their money in less than 6 months. So be prepared for things like that. And the way that you do things like that is obviously have your auditors, legal counsel involved to make sure that you're structuring things, even doing things like your board meetings. The right law firms will show up to take notes. They will deliberately take very vague notes. It's not that they are not detail oriented, but the right law firms understand that. Let's say you walk in and you say, we think we're going to run out of money in 30 days. That's definitely something the law firm needs to understand. That's probably not the kind of thing that they want to document. So what they're going to do is they're going to take notes. So if you approve options, if you approve a financing range, or if you just authorize the issuance of shares based on the last round of financing, those are the formal things they're going to say. The board got this list of investors. They approve the entry into Carta that you use to track your equity shares. They approve this particular executive hire with X number of options they're going to invest on this period of time and this salary level. Those are the kinds of things they will formally document in your notes versus troubling issues. So let's say you think you might get into a situation like OpenAI just got into with Apple, where they got sued. They probably had an idea something like that was going to happen ahead of time. I guarantee if you looked at their notes, their general counsel internally would have had really detailed notes about what's going on. But as far as a board meeting, that kind of stuff would never get documented. They're definitely going to have talked about it, prepared for it, and said, we think this is going to cost $50 million to defend against, but we spent $6.5 billion buying Johnny Ive's company. So, well, we don't want to spend $50 million. We're obviously prepared to put that amount of resources against defending this because we don't think we did anything wrong. Or in a worst case scenario, they did do something wrong. They shouldn't have done it. And then from there, they got to create reserves in terms of how they could potentially settle with Apple. Thanks very much. You guys have any questions?
Thanks, Scott. That was great. A lot of really good information there. I don't know whether has anybody got any questions or anything they want to share. Obviously, we've got a few more minutes. Feel free to jump in.
Chris, I would just repeat what you said. I've been through a lot of webinars recently, and Scott, I think this was great material, really helpful.
Hopefully it was useful.
Hey, Scott, quick question. For clients looking in that, let's say, $1 to $10 million equity raise, so to speak, any thoughts on best places to go for that as opposed to some of the bigger places that you've been talking about?
What I'd say is typically between, call it the $1 to $10 million range, you're typically, historically, again, going back like 10, I'm going to date myself a little bit here, going back 20, 25 years, that was kind of seed stage investments. Typically, like a $1 million range, you're looking at angel investors. And it's obviously a lot easier if you're in some place like Silicon Valley, New York, potentially even places like Miami, Florida, where a lot of people relocated from New York. You get people that can literally write $1 million check over coffee, not think twice about it. It's a good problem to have, but obviously not a lot of people know people like that. The other places you can do is there are typically fundraising sessions you can do locally. I don't know where you are, David, in terms of what you do, but I know in Northern Virginia, when I was with Ernst & Young, we started something with my college called Grub Stakes, where we'd have the earliest stage entrepreneurs that were looking at kind of the $500,000 to $1 million. So you typically have firms like general partners or even wealthy angels that had made money, didn't have to be in tech. They were just kind of people that had made enough money. They were like, I made my money as an entrepreneur. I want to invest and give back. So you can find things like that locally. The other thing we didn't really touch too much on, but the geography is really important. Some of the best investors are in places like Silicon Valley, but you need to understand the difference for what's early stage in places like New York, where your stereotypical investor is going to come out of someplace like investment banking, versus Silicon Valley. The investment banker is definitely going to be able to create the most intense financial model you've ever seen, but they're probably not going to have the typical approach to venture. It's succinctly have a hunch, bet a bunch. So as you look at where you're located with the early stage deals, typically the smaller checks, the closer you can find those investors to where your company or your client is, that'll typically give you a leg up. Very simply, it costs them the same amount of time and effort to write a $5 or $10 million check. That's not to say they want to have to write a check for $5 or $10 million, but in a situation like the 1 to 10 million range, it costs them the same amount of time, money, and effort to write a $10 million check as the $1 million check. And you run into situations where, unless it's an individual that's got a particular passion for what you're doing, they're probably not going to write that $1 million check from a traditional institutional fund.
Yeah, that makes sense. I'm in Indianapolis, by the way.
The other place that you can look if you don't know a lot of folks is there's the National Venture Capital Association, which is nvca.org. It's the trade association based here in DC. It's a pretty long alphabetical list in terms of venture funds. It can take a really long time, but let's say you're on a vacation, you're looking for something to read, and you've got something like an iPad. If you're sitting by the pool watching your kids or just kind of relaxing on the beach, you can spend your time working down that list. And if you look at it, now most funds will tell you our target is $1 to $10 million deals, $10 to $50 million deals. Typically, you want to target a fund that's going to 1 to 10 million. I'd say you're probably looking at like a $50 to $100 million fund, because they're going to have the capacity. Whereas if you target somebody like Carlyle, that's located here in the DC area, they're a multi-trillion-dollar asset manager, and they've had venture funds that they've done, but their venture funds have typically been $10 to $50 million deals. So even though they call it the same thing, it's not the same in terms of what you're looking for.
Perfect. I'm conscious of time. I'm we're kind of 1 minute off, but I'm going to send an email follow-up. Are you happy for me to share perhaps your email address, Scott? So if anyone's got any follow-up
Sure.
questions, they can. Okay. So I'll send an email. Scott's details will be on there. If anyone's got any further questions, feel free to reach out. And are you okay to share a copy of this slide? Oh,
Sure.
I've
No
got
problem
it.
at
So I
all.
can share that as well. All right, brilliant. I really appreciate you taking the time to prepare and present, Scott. It's been really great. Thank you.